Good morning. My name is Anita COURS. I am a professor of finance at the Milan School of Management in Italy. Welcome to this video. If you're here, it means that your company took part of our research project on entrepreneurial sustainability and access to finance. Many thanks for this. To thank you for your time, we will share a final report with the results of the study, and we also prepared this video, which is a short introduction to venture capital financing. This is a preview of an executive course I teach at the Milan School of Management addressed to entrepreneurs. I hope you will enjoy it. First of all, what is venture capital and why is it important? Venture capital is a form of external finance for promising entrepreneurial ventures. Access to external finance for these ventures is very difficult, as you surely know. Survey data, in fact, reveals that in the most recent years, running out of cash and the lack of financing have consistently been among the most important reasons for startup failure. Venture capital could represent a possible solution. In fact, venture capital firms provide external finance in the form of equity to innovative startups, often operating in high-tech industries and with a clear potential for growth. Venture capital firms buy equity shares in the companies in which they invest, which implies that they become shareholders in these companies. To better understand what securing venture capital financing implies for the startups, it is useful to get acquainted with the functioning of venture capital funds. Venture capital investors invest through venture capital funds, which are boxes that collect the resources of other investors, the limited partners in the fund. So venture capital firms do not use their own money, they use the resources of the limited partners, which are institutional investors such as pension funds, endowments, and in Europe, for instance, the European Investment Fund. Venture capital investors use the resources collected into funds to invest in startups. They usually finance around 5 to 10 companies called portfolio companies. The investors will help the company grow till the moment in which the shares of the startup can be sold to a potential acquirer or through the initial public offering of the startup itself. This is the moment in which the investor, and sometimes also the investee, exit from the startup and realize a return. In this sense, venture capital firms are financial intermediaries. They invest the resources of their own investors into startups with the aim to generate a financial return in exchange for fees. Entrepreneurs interested in securing venture capital financing and being included into their portfolios should be aware about the fact that venture capital investors are very selective in the provision of financial resources, and success rates in applying for venture capital funds are as low as 1 or 2%. In the example, we see a typical venture capital funnel. For 100 companies that contacted a venture capital investor, only 10 are considered and analyzed by the investors in a preliminary due diligence phase. 3 receive a term sheet, which is a preliminary contract. 2 of them will go through a final due diligence, and then eventually only 1 will sign a contract with the venture capitalist and secure the financing. From the point of view of the entrepreneurs that are seeking the funds, it is essential to understand what specific features venture capital investors look for in a startup when selecting their portfolio companies, and how to successfully go through all the selection stages and due diligence. The venture capital investor and the startup also have to agree on how to structure the deal. So basically to understand how much money will be provided to a startup in exchange for what. Since venture capital investors provide equity, for a given financing, investors will require a given number of shares in the company, and usually these are newly issued shares. But how many shares? This depends on the post-money valuation given by the investor to their investees. In the example, the post-money valuation is $1 million. Therefore, if the company needs an investment of $100,000, they will have to give in exchange 10% of their shares. Now, what is the post-money valuation? It is very difficult to come up with a number, but there are some techniques that venture capitalists use based on multiples and discounted cash flows. The lower the valuation given to a company, the more shares a venture will need to sell to their investors in exchange for a given amount of resources. This implies a stronger dilution for the entrepreneur. That is, the venture capital investor will hold a higher percentage of the shares, and the entrepreneur will be more at risk of losing control of its company. It is essential for the entrepreneurs to understand how dilution works, especially through different rounds of financing. Eventually, the venture capital investor typically hold minority positions in the portfolio companies, so they hold less than 50% of the shares. However, they do not buy common shares, as the ones in the hands of the entrepreneurs, but preferred shares, which have special cash flow rights and control rights attached to them. It is essential for the entrepreneur to understand the jargon used by the investor, the features of these shares, and the consequences for them. An important feature is, for instance, the liquidation preference of the investor, which describes how exit proceeds are shared between the preferred and the common shareholders upon exit, so when the company shares are sold. In general, entrepreneurs should seek legal advice when reading term sheets. Upon investment, venture capital investors provide the resources to portfolio companies, but not only financial resources. In fact, venture capital investors are not merely financial investors, they are also professionals with very strong managerial experience and often entrepreneurial experience. And this experience may very well complement those of the founding team in an innovative startup. Moreover, the investors are very often specialized in a particular sector, which give them access to technical knowledge and networks of potential customers, suppliers, employees, and other relevant investors for the startup. Venture capital investors are willing to share their knowledge and their networks with their portfolio companies to see them grow and realize higher financial return. Here, there are some examples of companies who got venture capitalists before becoming the leaders in their respective sectors. As said, venture capital investors will want to exit from their investments, which means they want to sell their shares to someone else. Investors will try to sell their shares to financial investors or strategic partners, so corporations, or through the initial public offering of the company. The picture shows the very well-known initial public offering of companies that got venture capital, ranging from Google in 2004 to Qualtrics in 2019. One way or the other, when selling their shares, venture capital investors realize a return, and these returns will determine whether the venture capital investors will be able to continue its life cycle and continue to fundraise. The number of venture capital investments has been growing over time, and this is a picture showing the investment trends in Europe according to PitchBook, which is one of the most important data providers for venture capital information. We can see that the industry has been growing quite a lot, especially in 2021 and 2022, while it had a stop in 2023. This year was in fact characterized by high inflation and turbulent stock markets. In 2022, the industry reached the 110 million euro total investment amount. Venture capital investors invested in more than 13,000 companies all over Europe, and the average investment was 8 million euros. The median was closer to the 5. The picture also shows that venture capital investors prefer sectors such as software, consumer goods, services, biotech, and pharma. Overall, venture capital investments imply some advantages for the startuppers, but also some potential, let's say, points of attention. In terms of advantages, we talked about the fact that companies secure venture capital and then they are able to grow faster than their peers, thanks to the financial and non-financial resources. In terms of points of attention, we mentioned the low success rates in securing venture capital, the risk of dilution, and the complicating contracting with the investor. If you are interested to understand more of these concepts, please consider the course offered by the Milan School of Management, during which we will address all of these issues in detail. Specifically, we will discuss about which entrepreneurial characteristics make a startup attractive for a VC. We will see what an entrepreneurial team should be looking for in their own venture capital investors. We will also talk about dilution through different rounds of financing. We will review valuation techniques, and we will talk about contractual features such as liquidation preference, anti-dilution provision, so on and so forth. We will see more in detail how a venture capital can help its portfolio company prosper after the investment till the moment of the exit. We will look at numerical examples, real case studies, and real data on the European venture capital ecosystem. Many thanks for your attention. I hope to see you in class soon.